Hey everyone, welcome back to the channel. The crowd saw headlines, institutions saw exit signs. What happened on May 7th was not random, it was engineered. This is the real psychology behind the institutional trap. Today, we are diving into something deeper than just market news or technical analysis. We are talking about the psychology behind price moves, especially when geopolitics and retail emotions collide. Specifically, we are unpacking what really happened during Operation Sindoor, the India Pakistan border conflict that escalated in the first week of May 2025. To be precise, on May 6th, 2025, the Indian government confirmed a major cross border surgical operation in retaliation to terror infiltration, and instantly, defense stocks lit up the charts. Stocks like HAL, BEL, BDL, and Mazgaon Dock spiked at the open on May 7th, with some gapping up 4 to 6% in pre market trades. But here is a plot twist: within hours, these same stocks reversed sharply. Some even closed in the red, and thousands of retail traders who thought they were being smart by chasing the war rally ended up being deep in the red. So, what really happened? Because on the surface, it made sense. India enters conflict, so defense stocks should boom, right? No, but wrong. And this is the exact kind of situation where retail investors often fall into the herd mentality trap, following headlines, reacting emotionally, and ignoring what the smart money is doing behind the scenes. So while retail traders were buying the news, institutions were quietly selling into the spike, having already priced in the conflict weeks earlier. So, what was the result? A textbook case of a buy the rumor, sell the news move. So, in this video, I am going to break down why defense stocks did not rally the way retail investors expected, and how institutional investors front run these events and use retail liquidity to exit. And most importantly, we will figure it out what you can learn from Operation Sindoor to avoid the same mistakes in the future and become a smarter, more strategic lead trader. This is going to be a full blown breakdown: market psychology, real charts, FPI data, options trades, and historical context. So, whether you are new to the trading or a market veteran, there's a ton to take away. So, let's get into it. So, when conflict strikes, headlines explode, and social media goes into overdrive, and many retail investors fall into the same psychology trap over and over again, and that is the herd mentality. They see a news flash, a defense company mentioned in a viral tweet, a screenshot of someone's big gains, and they think this stock has to go up. But let's pause right there, because what actually happens tells a very different story. And this has not happened first time. The history has repeated itself thousands of times. For instance, after a flare up in Middle Eastern tensions made headlines, major defense stocks like Northrop Grumman, which is truly named by NOC, Lockheed Martin, LMT, Raytheon, which is RTX, opened 4 to 5% higher at the bell. Retail chatter on Reddit, X, formerly known as Twitter, and Telegram. They were all filled with comments like, War is money. Just buy LMT and hold. Every time missiles fly, defense stocks boom. Easy money. These were the comments floating over. But same day by 12:30 p.m., can you guess what happened? The rally completely reversed. Stocks like RTX not only gave up all the gains, they ended the day down nearly by 2%. So let's break down what exactly happened. So, two core psychological traps kicked in. First one is the FOMO and the social proof bias, which is fear of missing out, which is a powerful force. When people see others jumping into a stock, they assume there is an insider knowledge or a guaranteed payoff. And thanks to social proof, the more people who buy, the more others feel compelled to follow. It becomes a feedback loop, which is not based on analysis, but on crowd behavior. And another example is a Google Trends showing a 360% spike in the best defense stocks to buy. Can you guess what was Robinhood's most added stock that day? It was RTX and LMT. But the inflow wasn't driven by institutional research, it was driven by hype. Second in our list is the loss aversion. And this one is a kicker. When the initial spike fades, and it always fades fast, panic sets in. Retail traders who bought high begin to sell out quickly, terrified of losing more money. And this is the loss aversion in action, which is a well studied concept in behavioral economics. We fear losses twice as much as we enjoy gains. So, what do retail traders do? They sell at a loss, locking it in, while institutional players quietly accumulate at a discount. Just look at the intraday volume charts. Massive spikes at market open from retail platforms were followed by sharp volume drop offs and reversals driven by institutional selling. And this isn't random, it's quite predictable. Institutions knows this retail behavior. They plan for it. They front run the panic, upload into the spike, and buy back in after the drop. And what's the result? Retail gets in last and gets out first every single time. So, if you're wondering why this pattern repeats so often, stay tuned. In the next section, we will unpack how historical events from the Ukraine invasion in 2022 to the Hamas Israel conflict in 2023, they all triggered the same psychological chain reaction, and how smart investors can learn to break free from it. All right, institutions versus retail, which are the opposite sides of the table. So let's be clear, when geopolitical events hit the headlines, retail investors are often reacting. Meanwhile, institutions are already repositioning, often weeks in advance. So we're talking about FIIs, mutual funds, pension funds, and high frequency trading firms. These players manage billions, and they don't wait for a news flash on CNBC to make their move. So here is how the pros think. Institutions had already priced in the war risk. For example, in April 2025, weeks before Operation Sindoor began, defense and shipbuilding stocks were already quietly rallying. So if you have noticed, BDL was up 20 by 21% between April 2nd and April 30th. Hindustan Aeronautics gained 14% during the same period. Mazgaon Dog Shipbuilders surged nearly 18% during the same period. And you must be wondering why. And the answer is because institutional players were reading geopolitical signals, they were watching military procurement contracts, and were anticipating a conflict escalations well before the first headline broke. They understood that military tensions were already a tailwind, and they bought the rumor. But then comes a twist. When the war finally starts, they sell. This is a classic buy the rumor, sell the news behavior. On 7th May, as Operation Sindoor dominated national headlines, defense stocks spiked at the open and then tanked. Moscow Dog is a perfect example. It opened 5.6% higher, driven by frenzied retail buying, but then plunged over 6% intraday, closing the day deep in the red. And you must be wondering why. And the answer is institutions were already offloading their positions into the rally. They did not need to wait for confirmation. The news was just a trigger to exit. And here is where things get even more strategic, and that is algo trading takes over. Today's market isn't just humans versus humans, it's humans versus machines. When high frequency trading systems detect sudden retail inflows visible through order books, volumes on discount broker platforms, or unusual buy side imbalances, they trigger automated sell programs. These algorithms are designed to drain liquidity from retail driven spikes, to accelerate volatility, to shake out weak hands, and to short stocks at key reversal levels for fast intraday profits. So while a retail trader is placing a market buy order based on emotions, an algo has already detected the imbalances, shorted the spike, placed the layered sell orders, and moved on to the next setup, all within milliseconds. So think about this. You are buying based on headlines, but institutions are selling based on volume signatures, volatility models, and profit zones. So you're watching the news, but they are watching you. This is why it feels like retail investors are always a step behind, because they are, but it doesn't have to be that way. In the next section, we will break down a few case studies from past geopolitical events where the same patterns repeated, and we will show you how to recognize the signs before the reversal hits. So, this behavior isn't new. Retail overreaction, institutional discipline, and post conflict rebalancing. They have all played out again and again across decades of market history. Let's rewind and look at a few pivotal moments where emotions clashed with fundamentals, and the winners were those who saw beyond the headlines. All right, let's look at 1999, the Kargil War. When the Kargil conflict broke out in May 1999, the Indian stock market initially reacted with uncertainty. Retail sentiment was fearful, and the Sensex dropped around 286 points in the weeks following the escalation. But here is what's interesting. Defense related stocks did not spike during the conflict. They surged after it ended. By the end of July 1999, after India declared the conflict was over, stocks like BEL and HAL saw double digit gains over the next few quarters. And you must be wondering why. And the answer is because the war exposed gaps in defense preparedness, and that triggered new procurement orders, budget allocations, and long term reforms in the sector. So the real opportunity came after the panic passed, when institutions began rotating into defense on policy clarity. Next one, 2019 Pulwama attack and Balakot airstrike. On February 14, 2019, a suicide bombing in Pulwama killed 40 CRPF personnel. The news triggered a wave of panic selling. The Nifty fell 1.2% the next day, with defense related stocks seeing early dips. But the market rebounded sharply just days later, and the months that followed, HAL rose from 620 rupees in February to over 1000 rupees by September 2019, a gain of 60%. BL gained 45% over the same period. Even public sector shipyards like Cochin Shipyard saw renewed institutional interest. So let's understand what exactly happened. Institutions were already pricing in higher defense spending in the union budget, and post Balakot strategic shifts and Make in India tailwinds. This was very clear. But retail, in contrast, was reacting to fear and headlines and was selling the lows during the spike in volatility. And the pattern is clear. Short term fear is equivalent to panic plus volatility, but long term thinking is equivalent to profit plus positioning. So markets always overreacts in the short run. And if you are swept away by social media narratives, you will likely to be on the wrong side of the trade. But the smart money waits. They buy when the dust settles down and when the fundamentals start to shift and when policy clarity emerges. And that's knowing the history helps you see the setup. And then only you will stop asking, why did it fall even though the war break out? And will start asking, who is already positioned? Who is exiting? What's being priced in? So in the next section, I will give you a simple framework to decode retail versus institutional behavior, so you never get trapped in the crowd again. All right, now let's zoom in and dissect Operation Sindoor as a real-time case study, which is a perfect example of how herd mentality meets institutional strategy. This isn't theory, this just happened, and the numbers tell the full story to us. All right, to build the context, on May 6, 2025, the hype begins. It started quietly, but very fast. A few defense analysts on Twitter posted cryptic updates about rising troop movements and naval activity on the Western Front. Telegram and YouTube channels started pushing headlines like, wartime boom coming, buy these 5 defense stocks right now. According to Twitter, trending data, tweets mentioning defense stocks spiked by over 300% in 12 hours. Stocks like Mazgaon Dock, HAL, BEL, and Cochin Shipyard surged 3 to 5% intraday on pure anticipation. But no official war announcement had been made yet. This was retail FOMO kicked in, driven by social signals and not fundamentals. But behind the scenes, institutions were already preparing to exit. So on May 7th, the trap begins. So at market open, the war was confirmed. Operation Sindoor had officially begun, with India launching coordinated strikes across the border. Retail investors piled in at the opening bell, convinced this was the beginning of a major rally for defense stocks. And Mazgaon Dock opened 5.2% higher, same as BL jumped 3.8% at open, and HUL rallied over 4.5%. But by noon, they were all falling hard. Mazgaon Dock reversed completely, down over 6% from the open. BL and Cochin Shipyard closed the day in the red too, and HUL lost all its early gains. You must be wondering why. Because 3 coordinated market mechanics were at play. So let's understand them. First one is institutional profit booking. Institutions had already built positions through April, when defense stocks rallied between 15 to 20% on procurement news and soft pre-war signals. So, what was May 7th? Yes, it was a sell the news event. Institutions used the retail buying wave to exit at a premium and left the crowd holding the empty bag and losses in their hands. And next one is algo triggered sell orders. High frequency trading systems picked up on abnormal order flow and thin order books on defense counters. The moment they detected buy side imbalance and volatility spikes, they shorted the upside and placed rapid sell orders. This strained liquidity created a cascading price drop, which is a textbook setup to flush out late buyers. And the outcome was that the retail investors watched their holdings turn red within hours. They panicked and sold into the weakness, which further amplified the drop. All right, the last point is liquidity vanished. As volatility spiked and the bid ask spreads widened, market makers pulled back. Without enough institutional support or fresh catalyst, defense stocks could not sustain the move. Retail demand dried up, and with it, the floor collapsed. But here is a twist. On 9th May, smart buying returned, but very quietly. Just when retail traders had given up on a defense, calling it a pump and dump, buying interest quietly returned. Buzzgow Dog bounced nearly 4% intraday. BL and HL shot strong accumulation in the second half. Volume profiles indicated institutional footprints with large block trades and not retail chasing. So, what exactly changed? The change was that overreaction was done and evaluations were attractive again. So, after the 2 days of panic selling, defense stocks had corrected by 8 to 12% from their May 7 high, but nothing had changed fundamentally. Order books were intact, margins remained healthy, government defense spending was expected to increase and not to shrink. And for smart money, this was a classic second entry setup. The hype is gone, prices are fair again. Let's rebuild positions, and that too quietly. And that's how institutions play retail traders. So, second one is the policy expectations re-entered the narrative. All right, defense insiders and policy analysts started floating credible speculation. A new 30,000 crore rupees indigenous defense procurement push could be announced post conflict. Talks of expediting Make in India drone and missile projects gained traction. The geopolitical environment meant long term spending on defense was only going higher. This wasn't noise, it was a real fundamental catalyst, the kind institutions trade on. All right, the next one is the sentiments was flushed. Now it was safe to re enter. Ironically, the best time to buy is often after the panic. So by May 9th, retail traders were out. There was no more euphoric buying to distort prices. What volatility had settled down, and algo activity dropped. So risk reward was back in favor of long term positioning. So institutions began accumulating gain, but quietly. There were no headlines, there were no hype. And that's our final twist. Retail jumped in when it was noisy and emotional, and they got burnt. Institutions re entered when it was quiet and rational and got value. This is how the same asset, the same story, becomes a trap for one side and an opportunity for the other. So, in the next section, I will give you a simple framework which you can use next time when a headline spike and social media screams. By now, I'll give you a simple three-part framework to avoid being on the wrong side of these traps again and actually position like the pros when geopolitics hits the headlines. Because if you understand the phases, hype, panic, flush, re entry, you will never get caught in the wrong side again. So, how do smart traders avoid getting trapped in the hype and instead capitalize on it? Let's understand. The answer lies in having a disciplined toolkit, a blend of sentiment reading, macro context, and risk control, and contrarian patience. All right, let's break it down further. First one is understanding the sentiment volume divergence, which is an indicator of potential danger. When everyone is suddenly bullish, be cautious, especially if volume spikes before fundamental shifts. Always use tools like, StockBits or Twitter to track ticker mentions. So purpose behind is that stock retail hype spikes before price reversals. So you can go to StockBits, look at the trending tickers. These are the ones being heavily discussed. Click on a ticker, suppose like Moscow, and read recent posts to gauge emotional sentiments. If 90% of posts are blindly bullish, it's likely late in the move. And you can go on the Twitter and use BEL, HAL, or stock name searches. Look at sudden tweet volume searches. Tools like Twit Binder or Lunar Crash can help you analyze volume over the time. You can use Google Trends to measure retail attention. Purpose behind is that quantify retail interest over time is often a leading signal for price tops. You can go to Google Trends, type in search times like HL share, best defense stocks, or BL stock price. Set the region to India and the time frame to past 7 days or 30 days. And you can look for a sharp spike in research interest around the same time price is peaking is equivalent to likely short-term top. Peak interest is usually followed by price fade as smart money sells into the high. Alright, you can also use Trend Spider or TradingView to overlay sentiment with intraday volume. And the purpose behind is to spot volume divergence when the price is rising but volume is unsustainable. In TradingView, you can search for stocks PEL and add indicators like volume profile visible range, which shows where the big money is positioned. And also, you can use along with that on balance volume indicator, which measures if prices rise are supported by real buying. If price breaks out but OBV is flat or is falling, it's a fake out fueled by retail and is likely to reverse. You can add the total sentiment indicator if you're using, of course, a premium account or an extension. It can track how many positive or negative tweets are made about a ticker over the time. In TrendSpider, which is a paid tool, you can use raindrop charts to track volume weighted sentiments, which is a large upper wick with big volume and measures the buyer exhaustion. You can use smart checklists to automate sentiments signals, and you can set up alerts when sentiment and volume exceed a certain threshold. All right, for you as a retailer, a red flag setup will look like that a small cap defense stock shows a 40% increase in the volume plus is trending on the social media, which is likely coming to an exhaustion point. So, as a smart move, you don't chase a spike, you watch for the divergence. For instance, you will watch the RSI is weakening while the price is still rising. This usually signals a reversal in near term. Next one is you can follow contrarian entry points, which means buy when everyone's is out. Wait for signs that the panic is over and institutions are moving back in. And here is how you can watch put call ratio. So if PCR is less than 0.7, market is overly bearish and has a potential for reversal. But if the PCR is greater than 1.3, it means market is overly bullish and the risk of sell-off is near. So on May 9th, defense PCR dropped to 0.66, which was indicated oversold territory. So contrarian entry rule is that when PCR is less than zero point 0.7 and volumes are falling, which means sentiment has flushed and it is time to buy fundamentally strong stocks. All right, coming to the next point, which is to execute gap trading adjustments and play the rebound safely. So when the big news comes, it means gap ups or gap downs. But trading them naked, especially with options, is quite risky. So instead, use bear put spreads in overheated stocks or use bull call spreads when entering after panic gaps. So, for instance, instead of buying HAL calls after gap up on May 6th, a bull call spread, for instance, buy 3900 CE, sell 4100 CE, which limit your downside and will still capture upside. And also remember, gap fill reversals are common. What opens up can fade by noon and bounce by close. So smart traders do not chase gaps, they fade them or structure spreads to profit from volatility and just not from direction alone. So execute macro hedging, which is a professional move. Smart traders hedge their geopolitical exposure with market neutral positions. So let's go back to the operations and do it. On May 6th, long, being long on BL was profitable. That was plus 8% in 3 days. And short on Nifty features, that is 1% drop on May 7th. So this is called a delta neutral macro hedge, betting that defense would benefit from the conflict but protecting against broad index downside. And why it works? Because defense may rise on conflict, but index can fall due to FIF outflows or panic. A hedge protects you from the market wide stress while letting you play your theme, play perfectly. So, my final thought on this is that discipline is greater than emotion. Retail loses when it trades the narrative, but smart money wins by trading the structure. So your edge comes from waiting for the flush, by reading the volume with sentiments, and by managing risk with spreads, and by using macro data to guide timing. So in the next 30 seconds, I'll wrap it all up with one powerful mental model that helps you instantly record whether you are trading with the smart money or about to get front run by it. So we have covered strategies, timing, even sentiment data, but none of that matters if you can't control your own behavior and emotions. Because in events like Operation Sindoor, the real battle isn't in the market, it's your own head. So let's talk about how to build emotional immunity during high volatility events. So, first one is defining pre market commitment. By that I mean make the plan before the panic sets in. So, smart traders pre commit to entry price, exit plan, and max risk per trade, which is often lies between 1 to 2%. But the real problem is retail traders always jump in during the news without a stop loss and exit only when it hurts too much. So pre-commitment avoids emotional U-turns. Like, just this once I will hold through the dip. Or if it comes back to my price, I will sell. So my pro tip is that write your exit conditions down before entering. Use alerts, not your gut feelings. Next one is keep event-based exposure very, very small. Operation Sindoor saw some traders bet 50 to 70% of their capital on defense stocks in one day. And that's not a strategy, that's gambling. So instead, keep event driven trades to 5 to 10% of your portfolio. Use position sizing based on volatility. For instance, lower allocation to high beta stocks like Pulse Defense, but higher to the stable ones like BEL. So think of it like this: you're not trying to win the war in one trade, you're trying to survive long enough to win the next 100 trades. So always review and do the post mortem of your trade that most traders skip. Analytics has proved something very shocking. Only 23% of retail traders review their stop loss failures, and most did not even log what went wrong. So, if you don't study your losses, you are doomed to repeat them. So, smart traders do a three-part review after every trade. Did I follow my plan? Was my size appropriate? What did I feel? And when did emotion take over? So, my pro tip is that keep a trading journal. So, even 3 to 5 bullet points after each trade can transform your lead learning curve. My final thought on is that trading is not just about charts, it's about a character. You can't control the news, you can't control the market, but you can control how much you risk, when you enter, how you respond to fear and euphoria, and that's the real edge. And 90% of retail traders never develop it. So, my today's key takeaway is that markets thrive on punishing consensus. When everyone thinks defense will rally, and that's exactly when smart money exits. So, if you want to succeed as a trader or investor, your edge isn't just your charting or your news feed, it's your discipline, your data, and your ability to think contrarian when everyone else follows the herd. So, if you found this deep dive valuable, hit like, subscribe to the channel, tap the bell icon because I break down the real market psychology behind the headlines. And tell me in the comments, did you trade during Operation Sindoor? And what do you learn? So, see you in the next one. And remember, the market does not reward noise, it rewards insight. And thank you very much for watching.